All right, hello everybody. Welcome to today's Trend Signal podcast. My name is Adrian Boothie. I'm the head of trading here at Trend Signal, and today we're going to be talking about what's going on with the Forex and the stock markets in our usual podcast, I guess talking a little bit about Trump's recovery from COVID-19, but still continuing to lose ground to Biden in those polls as we move 22 days away from the presidential election now. So joined as ever to discuss all of this and make a lot of sense to it is our chief analyst and CEO, Jerry Miller. Hi, Jerry.
Hi there, Adrian. Morning.
Jerry, do you want to just take us through a little bit about what do we know? What's been going on over the last week or so?
Well, it's not a lot of data out last week, Adrian, but it was the sort of global macro events, as we tend to call them, which are sort of things happening around the world, and rather than sort of the micro stuff being individual data releases. But Trump and his COVID-19 infection, quite a few people in our workshop this morning believe that he actually never had it and he was just a ruse for some reason. But I have to say, if it was a ruse to help reinvigorate his campaign, then I don't think it's worked particularly well.
Do you know, it's funny you say that. My brother immediately on Facebook posted that he believed it was nonsense, but it's certainly backfired as far as the polls are concerned.
Yeah. Well, if you think about it, Adrian, his trump card, is the economy, which has done okay. But even then, the fact-checked site of the BBC website proved that actually 4 years on, the US economy is not in that much of a better condition in terms of its trade deficit, etc. I think it had a record trade deficit last month.
Yeah.
But it's just interesting. Why would he do something, i.e. pretend to have COVID-19, when he wants to keep that off the front page?
Yeah,
well, guess
absolutely.
what?
I totally agree. I don't buy it at all. I think it was he needed the argument to go away from COVID because of his allegations of mishandling, really, didn't he? And he needed a big story of something that's very different.
Well, he sort of did that with the appointment of that his choice for the new member of the Senate of the Supreme Court.
Right,
but
I don't think that's big enough. It's not big enough an issue, is it, really?
No, he couldn't keep it on the front page for long enough because he had to progress it. So that went off the front page, and well, guess what? It's all been this. But markets have ebbed and flowed, really, Adrian. But I think they just prove that with 22 days away, this election result is not going to affect the stock market really. It's more the bond market. And
that's unusual, isn't it? I mean, normally, it tends to have a bit of an impact there, particularly. And I guess we haven't got a huge, perhaps we don't have huge uncertainty over the vote. But normally, how would you expect the stock market to function, Jerry, into an election?
Well, the perceived rule is that with the Democrats, who are slightly more free spending and less financially rigorous, they tend to the markets tend to react quite negatively to a Democrat win. But in the past, the incumbent president, if the incumbent president, needing a second term, is struggling, the stock market comes off, whether it be Democrat or Republican, because there's a change of guard, there's more uncertainty. But that's not happening this time around, and the reason is that if we go back to Tina, there is no alternative. You can't put your money into anything else but the stock markets, even with Biden and the Democrats, perhaps getting away with what's called the blue wave where Biden and the Democrats actually win the presidency and also win both chambers of Congress. So that's the House of Representatives and, most importantly, the Senate. Because if they do that, they can push through any stimulus plan they need, really.
Yeah.
And we've talked about the $2.7 or $2.9 trillion, which the Republicans didn't like with this fiscal aid package. Well, guess what? After the election, assuming it does happen and there is a blue wave, they can pretty much call the shots. And that's been reflected in the bond markets, Adrian, without wishing to go too technical. The cost of borrowing money in the longer term has gone up as the bond markets are starting to price in the probable Biden victory and the probability that the government, US government, are going to have to issue more bonds to pay for all this spending. So there you go. That's it's happening in the bond market, but not in stock markets.
I guess, as you say, it follows a different different way, a different sort of reasoning, isn't it, between the bond markets and the stock markets. The stock market, there's money still sloshing around that's going to be invested. Where else are you going to put it? That's really all it ever comes down to at the moment, or at least over the last couple of years, certainly.
Yeah, definitely. I mean, the QE is all about, pushing investors into and savers putting their money to work and not keeping it tied up in cash, earning interest, because those interest rates have collapsed, as we know. Quantitative easing involves buying bonds. Buying bonds causes the yield to go down, so the return for investors, particularly private investors, becomes just nonsense. And there's no way retail investors look at bonds as a viable investment unless it's just for protection purposes. You get your fixed income per year, albeit nothing. At least your money's safe, and that's about as much as you could say for it.
Yeah, that doesn't really get the retail trader so excited. And I know when we talked about the Nasdaq whale, and then we went on to discuss the size of the retail market. He may be the whale might be a big mover of the market. However, the retail side, they're not so turned on by bonds or interest rates at next to nothing.
No, that's
they want to be looking at the Amazons, the Apples, and the Teslas of this world, which have the ability to make a lot of money, really.
That's interesting that you mentioned the Nasdaq well, because of course the market was sort of tugged around a little bit last week as Trump, in his narcissistic way, came back and was all talking about himself and how he's feeling and everything else, and then just announced that he was terminating the congressional talks about the second fiscal stimulus until after the election. The markets then fell, and then they rallied because he then put together some separate deals to aid the US economy, which really shoved equities quite a bit higher. And as you can see from the chart you just put up there, we're pretty much back to where we were at the beginning of September, when we were talking about the bump in Nasdaq volatilities and the big sell-off induced by reports that the Nasdaq whale had caused it all. But as you say, it was nothing in comparison to the aggregate amount of trades that the retail investors put on in options. So anyway, we're back where we started.
Yeah. So in terms of numbers last week, generally positive across the board for equities, indices, that is. So what sort of numbers are we looking at, percentage terms, Jerry?
Dow 900 points, so that's 3.25%. S&P 129, that's over 3.75%. And here in Europe, DAX 362, that's 2.8%. And even the little old FTSE with its rather unpopular stocks, banking and mining stocks, managed to tack on 114 points, and that was 2%. So yeah, all quite positive, but it's the really volatile US markets, which you'd expect with the election being so close, Adrian, that go up and down in large chunks.
Yeah, absolutely. You're going to say a different phrase then, weren't you? Something less politically correct, I think.
not in the podcast, for sure.
I know you too well. Okay, so very much a sort of a risk-on move. Risk-on being putting risk onto your portfolio, hence the rally in stocks. Effect on the dollar really being the other way, Jerry. Do you want to just take us through
Sorry, the risk on mode in equities also sees the dollar start to lose a bit of ground, because when there's risk off, conversely, investors and traders tend to buy the dollar as a bit of protection. So when it's risk on again, they then unwind those trades. So you'd expect to see the dollar slip a little bit in that sort of environment, which is what we had last week. Euro lost over a full cent, sterling lost over a full cent as well, and the yen sort of lost a bit of ground, but the yen trades is also a bit of a risk off instrument along with the dollar. So looking at dollar yen is not so relevant in that regard. But but that's what happened with the dollar.
Okay, and then in terms of the commodities, Jerry, we saw a modest movement overall on gold, and what was actually a sort of relatively volatile week, really.
Yeah, it was. I mean, we shanked the beginning of the week, but then come Friday, it basically made its week's gains in a week, and it's a bit of a sort of typical knee-jerk reaction in a way. I think it eventually rebounded on the back of the dollar's weaknesses during the week, So it's really just a dollar-related issue more than anything else. In fact, I did read a report, Adrian, that central banks were selling the most gold from their reserves in the past couple of years. So there is a little bit of pressure on gold at the same time, and that could explain its hesitancy above $2,000, and it must be a gift horse to central banks who are looking to rebalance their holdings.
Yeah, Gordon Brown would have liked that price, wouldn't he, all those years ago?
Yeah, what, as opposed to $280 an ounce.
Yeah, good call. Good call, Gordon.
Poor chappie. He goes down in history for that alone.
So crude oil, that was quite a strong week, wasn't it?
Yeah, it was. Crikey. I think that really caught off guard a lot of traders who was quite a bit of a squeeze there that pushed crude oil up sharply, actually. Brent crude or UK oil was up nearly $4, which is 9.5%. So that's a big move. And you might think, wow, what news was that to push that up? And I would tell you not a lot really, Adrian. Stocks were a little bit tighter, but nothing to suggest that sort of a move. But I think it was in response to the jump in equities that we've discussed.
Yeah.
And also remember, oil is priced in dollars. So yeah, that has an effect as well. The dollar weakness will have helped oil as well. And as I said, I think it was a bit of a short squeeze there, but nothing has much really changed too much with demand, which I think is expected to remain subdued for the remainder of the year. And it hasn't helped oil stocks in the US either. So despite the oil price rallying, oil stocks have remained under pressure, not just last week, but just generally.
Okay, yeah, well, absolutely. So well, I think that's mostly it for the week, Jerry. We do have a few events coming up, which we'll be tackling in our other podcast. So if you want to look at the Trading Week Ahead podcast on various podcast places, Spotify, SoundCloud, etc., then please do tune in for that. So just search for the Trading Week Ahead. If you'd like to learn some trading strategy as well, then you can book in for one of our free trading events. We do 3 of these a week, and where we're going to teach you, our attendees, a simple trading strategy that we use, one of our foundation strategies to help traders to boost their trading results. So 3 simple rules to identify turning points in the market, which we can apply to FX, indices, and commodities. So if you'd like to learn a strategy to help you to identify some great turning points, then please do tune in. You can go to bit.ly, so bit.ly/learnts, bit.ly/learnts, get yourself booked in, get a pen and paper, and we'll teach you one of our favorite trading strategies. Otherwise, that's pretty much it from us. So have a great week's trading, and hopefully we'll see you at the Trading Week Ahead podcast a bit later on today. Bye for now.